Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
A growing list of companies are warning of a slowdown. Marriott cutting its full-year outlook, expecting weaker demand in North America and China. Marriott International President and CEO Tony Capuano joins us now. Tony, always wonderful to see you. Thank you for being in the studio. You know, I want to start. I feel like the U.S. consumer and the Chinese consumer are two completely different stories. So I want to start with the U.S. in terms of the greater weakness. Is it across the board, or is it this bifurcation that we just keep seeing? Higher end still spending, going nuts, lower end really crimped?
Well, there is certainly a bifurcation across consumers. The lower end consumer is feeling the pressure of economic headwinds. In fact, while we don't operate in the economy tier, they actually had negative revenue per available growth in the second quarter. But as you move up the chain scales, we are seeing continued strong RevPAR growth really across segments and across geographies. In fact, the strongest growth we saw in Q2 was in the luxury segment. And so that luxury customer continues to spend, continues to have confidence, and continues to prioritize spending on travel and experiences versus hard goods.
Can you give a sense of, in the non-luxury segment, where consumers are pushing back, what they're not willing to spend on in the same way that they were, say, a year ago?
Yeah, so it's really interesting. If you look at our Q2 numbers, with the exception of Greater China, which I know we'll talk about, we saw strong growth across every geography and across all three segments we operate in: business transient, group, and leisure. So it's not that we're seeing really a pullback in travel. We are seeing a little bit of a level of caution in some of the related discretionary spend. So when you look across most of the markets we operate, food and beverage spending, for instance, was down a bit. So those consumers, it appears, are still prioritizing travel, but maybe they're being a little more judicious on their spending as they travel.
Well, Tony, you've been with Marriott for a few cycles, joining in 1995. I wonder, when you look at the consumer now and some of that concern, that pickiness of what you're seeing, how similar or how far away does it look from past downturns? I
think, well, from a macro perspective, not terribly dissimilar, other than the trend I just mentioned to Lisa, which is we have great credit card partners in American Express and JPMorgan Chase. And so we have really rich consumer spending data to evaluate. And pre-pandemic, you saw some of the younger demographics starting that shift away from purchase of hard goods towards experiences. Post-pandemic, it really appears to be across demographics. And that's a trend that seems to have the legs to endure long beyond the end of the pandemic. So I think that's a distinction. For Marriott, we're a different company than we were in different cycles. A higher percentage of our business is franchise versus managed, so you don't have that incentive management fee volatility. Higher percentage of our revenue comes from non-RevPAR related sources, like our branded residential business, like our branded credit card business. We're much more international than we were in previous cycles, but there are certainly some similarities.
And you have yachts now?
Now we have yachts. In fact, Ilma, our second yacht, launches next month.
Well, I'm just curious about this idea of investing in luxury. How much of this do you say, this is just of the moment, this split we're seeing, or we want to buy more boats? We want to have Marriott private jets in the sky. What does it mean to either just continue on the trend or double down on it?
Well, the good news is we're not buying any of it. You know, we're an asset-light model, so we have terrific partners who are investing meaningfully in luxury. And we want to lengthen the lead that we enjoy in luxury. We've got the industry's largest luxury footprint. We have the industry's largest luxury pipeline. We have the industry's largest luxury branded residential business, and yacht is just a natural extension of that. We find that luxury customer wants to spend a higher and higher percentage of their travel wallet with the brands that they really trust. And when we look, again, it's more anecdotal because we've only been in the water for 2 years, but more than 50% of the passengers have never cruised before. And so I think they look at that Ritz-Carlton brand as a little bit of a housekeeping seal of approval. And more than 75% of the passengers we've had are Bonvoy members. And so that 210 million member loyalty platform really gives us a channel to talk to them about our expanded offerings.
Before I move on to international, because I want to ask you about the Chinese consumer, I want to ask you about Hawaii. And I know you have a lot of concern. You put a lot of effort into rebuilding what was going on in Maui after the wildfires. Is tourism coming back?
It is. We just passed the one-year anniversary of those horrific fires in Lahaina. I had my whole leadership team in Maui just last month. The great news is the Army Corps of Engineers is to be applauded. The progress they've made in cleaning up Lahaina, preparing Lahaina for redevelopment is really encouraging. We had the commander who's running the effort give us a tour of Lahaina. There's a house under construction, which was really important symbolically. But the aloha spirit of Hawaii is as strong as it's ever been. Our people are passionate, they're resilient, they're excited to see tourists coming back, but they're still operating at occupancies in the 60% range. And so if your viewers hear nothing else, go to Hawaii. They need the business. It's as attractive as a destination as it's ever been.
So who is traveling right now? We spoke to the Four Seasons CEO yesterday who said the Americans are out there and they're traveling. They're seeing weakness with the Chinese consumer. Is that similarly what you're seeing? Yeah,
although interestingly, the high-end Chinese consumer is traveling a great deal, but they're not traveling in China. So when we reported our second quarter earnings, the highest submarket we had in terms of year-over-year RevPAR was Japan. RevPAR in Japan was up 21%, and a lot of that was driven certainly by American travelers, but by high-end Chinese travelers.
But also, how much is that driven by the weakness we've seen in the yen? And consumers, travelers want to take advantage of that.
That's the case. But I think that outbound Chinese traveler was locked down in a really significant way. And you've seen the Chinese government create visa-free travel across the APEC region. And so we're seeing strong outbound Chinese travel in Japan, Thailand, those sorts of destinations.
As an American company based in America, does it give you pause to keep the footprint in the size that you'd have in China, given some of the overlay of tensions between the two countries, as well as the lack of appetite to go beyond that APEC region by Chinese wealthy travelers?
Well, I have an expectation eventually they will come back. If you think about pre-pandemic, the growing middle class in China and their appetite to explore the world was one of the things that drove a lot of optimism across our sector, and I think that will come back eventually. To your first question, we've got a little more than 500 hotels in China today, nearly the same number in our pipeline, and almost the entirety of that portfolio is owned by Chinese companies. And so I'm not sure we're necessarily viewed as an American company in China because the assets are owned by the Chinese, and they love global brands like Marriott. And so, of course, our business thrives in times of political stability. And when you have ratcheting up tension between the U.S. and China, that's not great for travel. But our demand levels in China are back to pre-pandemic levels. The reason we reported such weakness in RevPAR is because of rate. And rate is soft, one, because a lot of the high-end Chinese consumers are leaving China to travel across the region. And the booking window, because of weak consumer confidence in China, believe it or not, is under 3 days. And so they're making those decisions very close to travel for in-country travel.
So just to tie this all together, I know that Marriott had a subdued kind of outlook going forward in terms of how quickly you can see some sort of normalization or at least reversal of what we've seen, particularly in the lower end consumer. How deep do you think some of the weakness goes, the reluctance? I mean, is this just a matter of economic uncertainty, or is this something that you're seeing escalate in a more significant way?
Well, I think your term normalization is the right one. Remember, we saw our business drop by more than 90% in the early days of the pandemic. So for the last couple of years, you've seen demand come roaring back. The benefit of those really favorable year-over-year comparisons has faded, and we're settling into a more normalized demand environment. Weakness in the consumer obviously hits our business. We operate in a cyclical industry, but I think everybody's waiting for September, and if the rate cuts that are expected materialize, that'll be a boost for the consumer. Obviously, I'm going to be watching you at 8:30 to see what the inflation numbers look like, but all of that factors into that mindset of the consumer. But the thing that gives me confidence beyond the next quarter or two is this almost sociological shift we've seen with this appetite for travel. And I think that bodes really well for our business.
Tony Capuano, thank you so much.
Pleasure.
Always wonderful to have you on the show. Marriott International President and Chief Executive Officer Tony Capuano, thank you. Joining us right now, we've got David Kelly of JPMorgan alongside Steve Ricchiuto of Mizuho. David, thank you for being on with us. I want to start with you. What's your reaction to this?
I think it's pretty good news because if you look at first of all, it was slightly better than consensus in the headline. I mean, very slightly. But if you look at what's still holding CPI up, we got a 1.2% increase in auto insurance. So it's still at an auto insurance anomaly there. And we did see a 0.5% increase in rents, but that's showing the rental numbers up over 5% year over year, and owner's equivalent rent up over 5% year over year. Now we know that is somewhat misleading, and I think the auto insurance number is also somewhat misleading. But everywhere else, inflation is nowhere to be seen. And I think that's really the important point, where in the actual transactions markets of the economy, where people are sort of bidding and asking for in terms of prices, inflation is disappearing. So I think that overall, this very much confirms the idea that inflation is heading down. I think over the next 2 months, we're going to have some relatively easy comps. So I think that by September, the Fed may actually hit its 2% year-over-year number on consumption deflator inflation. We'll see what happens. But overall, I think this is further confirmation that inflation is gradually whittling away.
So, inflation problem dead. Steve Ricchiuto, your take?
Complete opposite view. I don't think you should ignore things like what's happening in insurance rates. I don't think you should ignore things like what's happening in the housing market. I think what you're really looking at is an index. You take the index for what it is. You don't parse through the components, throw out what you like, throw out what you don't like, keep in only what you like. This is a problem that we have over and over again. This is a problem we have with people who want to look at a particular component like an unemployment rate or a yield curve and make macroeconomic forecasts out of it. The reality is it's a little bit like Chicken Little getting hit in the head with an acorn and saying the sky is falling. The reality is these are individual components, but they're individual components of a larger aggregate set of data. And that aggregate set of data is telling you, A, the unemployment rate is still low, B, wage gains are still happening in the economy. Inflation is not near the Fed's target. It's still 1 percentage point above it at the CPI level. At the PCE level, it is lower. And it's telling me that we have an economy that is still very, very healthy. So, again, they want to cut rates. They're probably going to cut rates in September because they've opened the door wide enough to, bring a Mack truck through it, or should say bring the Queen Mary through it. And the net result is they'll get what they want. But at the end of the day, is it going to have much macroeconomic effect one way or the other? To be honest with you, it's going to affect financial markets much more so than the underlying macroeconomic environment.
David, I just want to give you a chance to respond to that.
Yeah, well, as Steve and I have just got a slightly different view of this. I don't think this is an inflationary economy. I realize the labor market's tight, even with the unemployment rate up at 4.3%. But what's remarkable is how much wage growth has fallen very steadily all the way since March of 2022. And what that tells me is it doesn't matter how tight the labor market is. American workers are just not demanding huge wage increases. They're just not doing it. We're not seeing massive numbers of strikes. We're not seeing massive industrial action to try and get wage increases. Wages are still rising more than inflation. But if you look at core goods, if you look at food prices, if you look at energy prices, none of it shows inflation picking up. So we're heading back towards 2%. Inflation is cooling. It's cooling slowly. But I think the greater risk right now is the Fed. I think the economy is in a soft landing. It's in a good place. But if I'm the Federal Reserve, I want to try to get back to normal here because the risk of recession, I think, is greater than the risk of any resurgence in inflation.
David, not that this is a competition between you and Steve, but if the market had a vote, it would probably be voting with Steve right now. Front-end yields are moving higher by about 5 basis points. You're looking at equities giving up on their gains, except for small caps. That, to me, seems like a market that is saying, hang on, maybe the Fed can't cut as much as we thought it was going to. What do you make of that reaction?
I think, well, the thing is that I do work the details on all these numbers, and I was kind of surprised the consensus was as optimistic as it was in inflation. But I think people are looking for, at this stage, they want, okay, if we get a negative surprise in inflation, then maybe we can price in some more Fed rate cuts. If we get something close to expectations, then we'll sort of sell the news. And I think that's what's probably going on in the bond market. But it doesn't change my view that things are weakening here and on the inflation side. And the really important thing then is, where is the economy looking when we get to September? Because we'll get another inflation report, but importantly, we're going to get a jobs report for the month of August, and that's going to be really crucial here. Because if it looks like the economy is softening too much, I think the Fed can look at these inflation numbers, they can study them, they can be confident they're going to head towards 2%, but they don't want to be responsible for holding rates too high for too long and helping trigger more economic weakness. And so I think they'll be looking very closely at what's going on in the labor market and on the demand side of the economy.
So, Steve, David says the risk of recession at this moment is greater where we are than the risk of inflation reacceleration. Do you see that completely different?
Yeah, I don't see a real risk of a recession whatsoever.
But do you see risk of reacceleration of inflation?
If you wind up with an accelerated economy, the answer is yes. And that, I think, is the risk in this scenario. This economy really hasn't slowed much. Look at the GDP numbers. Yeah, we've slowed from last year's 3.3% number, but we continue to exceed expectations in terms of where we're going in the second quarter numbers and what we're looking like eventually in terms of where we are in the current quarter. The Atlanta Fed nowcasters are at very, very high rates of growth. And this becomes an ongoing problem, is that you do run the risk of a domestic cyclical story versus a global deflation story. And this really is the end result debate. We were talking about it earlier. This is the discussion, deflation versus cyclical inflation, globally versus domestically. Where do we pan out on this? David's right. Inflation has been coming down slowly. It's coming down slowly primarily because there is this real battle going on between these two forces. And the problem I see is if you start backing away from the pressure that's allowing you to achieve your target, you might wind up creating an environment where you stop improvement towards your target.
But what would you say to corporate CEOs that continuously say they are seeing this slowdown from consumers? They do see consumers deferring big spending.
Again, after an environment of 3.3% growth, which is a 1 percentage point above trend, you're going to see that inflection point. And that's a real inflection point. By the same token, you have services where spending is doing exceptionally well. And I think that becomes part of the problem. Again, it's the goods versus the services side of the equation. Services are doing extremely well. You're seeing that in some of the components that people want to throw out of the CPI report. The reality is it's services that matter domestically. It's goods that matter globally. Globally, it's a deflation story. Domestically, it's a cyclical inflation story. The currency sits in between the two, and where the currency goes from here will be critical. If we get back to 100 on your DXY measure, from having been as high as, 113, 116, that's a huge depreciation in the currency, and you could start to see some of these benefits on the good side of the inflation dissipate at the same time that you may see a little weakening in the service side of the inflation, and you wind up stuck at 3% inflation. Now, if the Fed's willing to be stuck at 3% inflation, fine. Bonds have to adjust to that.
David, we'll let you respond in just 1 second. I just want to, if you are just joining us, give you a sense of where we are right now. CPI month over month coming bang in line, as Mike was saying, with forecasters' expectations 0.2%, up from negative 0.1% in the prior month. Across the board, ex-food and energy 0.2% in line. CPI year over year coming in at 2.9%, just a touch below the expectation, and ex-food and energy 3.2% bang in line. All of this really suggesting forecasters are getting it right. Mike has been looking through the details, the line items that we can debate whether they matter or not. What are you finding in terms of interesting nuggets?
Well, I think part of this plays into the whole political campaign season that we're in now. Insurance prices are very mixed. We do see motor vehicle insurance prices going up significantly in the, if you look at X, formerly known as Twitter, I think you said that yesterday, a lot of complaints about that. But homeowners insurance is flat on the month. Medical insurance down just a little bit. So it's not a universal situation. Airfares were down by 1.6%. So if you're traveling, you're going to notice that. And overall, it is housing that has pushed this up. 90% of it was the 0.4 rise in owner's equivalent rent and shelter. And that the Fed can't do anything about. So they're going to have to decide, they'll go back to Powell's ex-shelter measure and say things are getting better. One other political thing, and I know Anne-Marie will appreciate this, bacon prices down 1.1%. So that was, I guess, a big issue on one of the candidates' public appearances this week.
Bacon was on your bingo card. Here you go. Thank you so much, Mike. David, Kelly, and Steve Ricchiuto still with us. David, I want to go back to you. And there is this real question about the line items and how much they actually matter versus just the overall aggregate index pointing to a certain type of scenario. What gives you confidence that we are not at risk of reacceleration at a time when, as Steve says, the dollar is actually weakening, and as the Fed is likely to cut, weakening even still?
Well, a falling dollar, although frankly it'd be a good idea if the dollar came down in the long run. It wouldn't, I think the dollar's been too high for too long, but that would add a little bit to inflation. But this is not an inflationary economy. Let's just pick up on airline prices, because I think that it sort of exemplifies the exact nature of the U.S. economy right now. Airline prices are down 2.8% year over year. But if you look at the number of people going through TSA checkpoints, it's up over 5% year over year. It is at an all-time record high. Americans have never flown more than they are flying today. The planes are all packed, and yet the airlines can't actually push up the prices year over year. They've had to push down their prices 2.8%. So, I know Steve is a little more worried about inflation going up. I'm a little bit more worried about the economy slowing down. But so long as we disagree in that way, the truth is the economy is just doing great here. What we're seeing is steady, low inflationary growth, with inflation gradually coming down, and hopefully the economy avoids recession. I do think the Federal Reserve ought to normalize rates to try to remove that risk, because I think they are distorting the economy by keeping rates a little too high at the short end for where the economy and financial markets are. But overall, this economy is in a pretty good place, and I hope that Steve and I are similarly disagreeing as vehemently in a few months' time, because that'll probably say the economy is straight down the middle, doing fine.
I mean, you hear that from the Fed, to be fair, as well, this idea that the economy is doing fine and they have time, and that means that they can just wait for more data. Steve, you look at this data, is the wait over? Do they have everything they need to cut?
If they could get a unanimous agreement, they will cut interest rates, yes. And I think you would need something on the labor market to do it. I think, we're arguing today over the CPI number. I think they've already taken that out of the equation. I think it's all about the employment numbers. And the claims numbers, we'll see what the retail sales numbers give us tomorrow. We'll see what the claims numbers give us. People aren't getting fired. What's happening in the unemployment rate is people are coming back into the labor force. They finally used up all that excess savings that most of my colleagues on the street thought they had used up, a year ago and hadn't used up. The reality of the situation is the transition that's taking place from a very abnormal recovery period to an expansionary period is going to be volatile. And reading through all the tea leaves, trying to look at one or two indicators makes an enormous amount of mistakes. What's important is the breadth of the data within the payroll employment report. It's like the breadth of the data within the JOLTS data, and I'm not a big JOLTS fan. It's the overall aggregate interpretation of the data. And this is what the chairman's trying to bring out. But by the same token, he also then wants to hang his hat on a particular component within a report to say, oh, well, this is what I'm looking at. But the reality is you can't have it both ways. And that's what they're trying to do. And I think that's what the markets are trying to do. They want the Fed to cut rates, and they want the Fed to cut rates a lot, but we don't want the Fed to cut rates too quickly that people begin worrying about a recessionary environment, and then the equity market goes down. So we want to craft an environment where bonds go up in price, equities go up in price, and everybody can go home happy. Doesn't always work out that way.
To that point, David, of whether or not the Fed likely they're going to be cutting in September, but now the debate is, do they go 25 or 50? If you think we're closer to the risk of recession than a risk of reacceleration, do you think the Fed needs to go 50 basis points in September?
I think I would like them to go 50 basis points, but only if they can message this as being part of a normalization, because honestly, rates are in the wrong place and they need to get to normal at a reasonably rapid pace. I think that's what they ought to do. But they have to message it that way, because the problem is that, as Steve said, if the Fed cuts 50 basis points and does it because they are scared of the unemployment rate going up too fast, it won't speed up the economy. It'll scare people. It'll cause people to halt business decisions. It will cause people to wait for lower rates before they borrow money. It will reduce the income for people, the $6 trillion in money market funds out there. So the problem is there's a J curve in monetary policy. When you cut rates, it actually hurts the economy before it helps it. And that's why they've got to be very careful here. Of course, the truth is they shouldn't be in the wrong place. They should never have raised rates as high as they did, and they should try to get back to a normal short-run interest rate of somewhere in the range of 3.5% to 4% and just stay there. But I do think that I think the employment report for August will be crucial here. I do think they ought to do 50 basis points, but I think they ought to try to message that as, look, the economy is fine. We're just getting back to normal at a reasonable clip here. We're not going to draw it out over a year and a half. We'll try to get back to normal a little bit more quickly than that. If they do that, I think they're managing the situation well.
Well, David, I guess what I don't understand then is if we're 50 basis points and we have more room for that, is that not sort of like an emergency cut? I mean, isn't 50 on its own something you wouldn't do if the economy is healthy?
Well, we didn't really have an accelerating inflation problem at all in 2022 and 2023. The inflation rate was coming down after June 2022, and we saw plenty of 50 basis point rate hikes. So I think the Fed has to sort of desensitize the economy a little bit, say, look, just don't freak out here. The big moves in short-term interest rates don't seem to have much impact on economic variables anyway. So let's just get back to normal. But it's a close call. I mean, the thing that I wish they'd started earlier, because then they could have started based on, look, inflation is steadily heading back towards 2%. We're very confident we'll hit 2%. We're going to take off the brakes here. They ought to start doing that earlier, because I agree that if it looks like they're doing this as an emergency rate cut because the economy's in trouble, that's only going to weaken the economy. So they have to be very careful in messaging. I think should start with expressing some confidence based on today's numbers that the inflation situation is on the road to 2%.
Steve, just final word, 30 seconds, your view on 50 basis point rate cut in September.
There's no way, given the dots, they can message that properly. Remember, this is a committee that went from several rate cuts before the end of this year to 125 basis points. And now we're talking about, in September, let's go 50. What are the dots going to do? Are we going to get a number of people on the committee to turn around and say, I'm going to reduce the dots? Are they going to be able to do that? They don't talk about the dots in that direction. So the reality is, if they go 50 basis points, then the question is, what changed so much that you only had one, that now you have two, and you're doing it all in one shot? And then what happens to the additional meetings for this year? So the reality is, like we saw the other day when the unemployment rate came out and the market moved, people jumped to the idea that when the Fed cuts rates, a recession begins. And this is a mistake. Typically, when the Fed has cut rates in the last 4 cycles, it's because we had a credit crunch. There is no credit crunch unfolding, and therefore there is no real need to move aggressively in monetary policy.
Steve Ricchiuto of Mizuho, David Kelly of JPMorgan, thank you both. We love having you on, especially together.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.